Warren Buffett once remarked, "You pay a very high price in the stock market for a cheery consensus." This quote highlights the idea that popular investments, often met with applause, can be overpriced and risky. In contrast, opportunities that elicit yawns or indifference from the crowd may offer better value. For contrarian investors, Buffett's insight serves as a reminder to look beyond market sentiment and seek out undervalued assets. By resisting the urge to follow the crowd, contrarians aim to uncover investments with strong potential that others might overlook. This approach requires patience and confidence, but it can lead to rewarding outcomes over time. What if the very wisdom that investors rely on is in fact contributing to hesitation or even leading to misguided choices? Could the familiar advice that's meant to guide us be inadvertently holding us back, causing us to second-guess every move? It's worth considering whether these well-worn principles are sometimes used as a shield for inaction or as a rationale for decisions that don't serve our best interests. By questioning the role of conventional wisdom, we open the door to a deeper understanding of how it shapes investor behavior, sometimes in unexpected ways. In this video, we set out to unravel the puzzle surrounding Warren Buffett's advice. While his words have inspired countless investors, understanding how to interpret and apply them effectively can be challenging. Our goal is to break down his guidance, clarify its meaning, and explore practical ways to use it in real-world situations. By the end, you'll have a clearer perspective on how to make Buffett's wisdom work for you. Let's begin our journey into the heart of his investment philosophy. In discussions around unconventional ideas, it's important to recognize the difference between genuine, contrarian insight and intellectual laziness. While true contrarian thinking challenges established norms with thoughtful reasoning and evidence, intellectual laziness often disguises itself as skepticism, but lacks depth and rigor. This distinction matters because not all opposition to mainstream views is valuable or constructive. Without careful evaluation, we risk elevating shallow dissent over meaningful critique. Understanding this difference sets the stage for a deeper exploration of how critical thinking and informed analysis can separate innovative perspectives from mere contrarian posturing. Many of us have encountered investments that seem dull or uninspiring at first glance. Perhaps you've chosen a savings account, government bonds, or index funds, wondering if these boring options could ever lead to meaningful growth. Today, we'll take a closer look at the widespread belief that only exciting, high-risk investments yield real rewards. Is there truth to this myth? Or do so-called boring investments have hidden advantages? Join us as we examine the evidence and challenge common assumptions about what makes an investment truly worthwhile. Warren Buffett's famous quote, "Be fearful when others are greedy and greedy when others are fearful," is often misunderstood by average investors and financial commentators. Many interpret it as a simple call to buy stocks during market downturns and sell during rallies. However, this oversimplification ignores the deeper message about discipline and rational decision-making. Buffett's advice is not about timing the market or reacting impulsively to short-term trends. Instead, it emphasizes the importance of evaluating investments based on their intrinsic value, regardless of prevailing market sentiment. By focusing solely on price movements, many miss the quote's true intent: to remain patient and objective, especially when emotions run high. The myth that investing in so-called boring stocks guarantees safety and steady returns has led to a simplistic rule: buy boring stocks. This approach assumes that companies with stable, predictable businesses are always less risky and more reliable. However, this belief can be dangerously misguided. Market conditions, industry disruptions, and changes in consumer behavior can impact even the most established firms. Relying solely on perceived stability ignores important factors like valuation, growth prospects, and financial health. Ultimately, blindly following the rule to buy boring stocks may expose investors to hidden risks and missed opportunities for growth. The idea that a boring investment is automatically safe, undervalued, or a good choice can be misleading. While some dull or overlooked assets may offer stability, others can carry hidden risks or underperform for extended periods. Assuming that lack of excitement guarantees positive returns ignores the importance of thorough research and market analysis. In reality, investments labeled as boring may face structural challenges, declining industries, or poor management. Relying solely on perceived safety can lead to missed warning signs and unexpected losses. It's essential to evaluate each opportunity on its own merits rather than relying on stereotypes or assumptions about risk and reward. When we dismiss a topic with a yawn and assume it requires no research, we risk falling into the trap of intellectual laziness. This mindset can prevent us from uncovering important details and nuances that could impact our decisions. In the world of investing, such complacency often leads to poor choices, as critical information is overlooked. By equating boredom with simplicity, we ignore the complexities that may lie beneath the surface. Ultimately, this approach undermines our ability to make informed, strategic investments and can result in unnecessary losses. Staying curious and diligent is essential for success. Warren Buffett's investment strategy stands in stark contrast to simple contrarianism. Rather than automatically going against the crowd, Buffett emphasizes the importance of thorough research and deep understanding of a business before making any decisions. He carefully analyzes financial statements, management quality, and long-term prospects, seeking intrinsic value rather than reacting to market trends. This disciplined approach allows him to make informed choices regardless of popular opinion. Buffett's success is rooted in patience, rationality, and a commitment to evidence-based investing, not in merely opposing the majority for its own sake. Many investors are drawn to the idea of simply buying so-called boring stocks, believing that this approach guarantees safety and steady returns. However, this strategy can be misleading. Relying solely on the perceived stability of these companies may cause investors to overlook important risks and miss out on better opportunities. The just buy boring mindset can foster complacency, making it harder to adapt to changing market conditions. It's essential to recognize that no investment is truly risk-free, and a more thoughtful approach is needed to build a resilient portfolio. As we move beyond the surface, a deeper question emerges. What does the yawn truly signify within Warren Buffett's philosophy? Far from being a simple gesture of boredom, the yawn serves as a metaphor for patience, discipline, and the ability to remain calm amid market frenzy. Buffett often emphasizes the importance of resisting impulsive decisions and tuning out short-term noise. In this context, the yawn represents a deliberate detachment from hype and speculation, allowing for thoughtful and rational investment choices. By embracing this mindset, Buffett encourages investors to focus on long-term value rather than fleeting excitement. The yawn here is not a reflection of the investment's potential or excitement. Instead, it symbolizes the calm and quiet environment that surrounds the decision-making process. In such a setting, distractions are minimized, allowing for careful and thorough analysis. This tranquility is essential for investors who need to weigh risks and opportunities without external pressures. It's within this peaceful atmosphere that thoughtful strategies are developed, leading to more informed choices. Ultimately, the yawn represents the value of patience and focus, rather than boredom or disinterest. When media coverage and market attention are limited, certain investments may go unnoticed by the majority of traders and analysts. This lack of spotlight can result in undervalued assets, as their true potential is often overlooked. Diligent investors who conduct thorough research can identify these hidden opportunities before they become widely recognized. By focusing on fundamentals rather than headlines, they are able to uncover value that others might miss. Over time, as these investments gain attention, their prices may adjust, rewarding those who acted early. In essence, a quiet market environment can be fertile ground for those willing to dig deeper and think independently. In a quiet environment, analysts can focus deeply on the intricate details of business operations and financial statements. The absence of distractions enables careful examination of balance sheets, income statements, and cash flow reports. This setting is ideal for methodically reviewing data, identifying patterns, and spotting potential risks or opportunities. The process is often slow and meticulous, requiring patience and sustained attention. Such an atmosphere fosters thoughtful analysis, allowing professionals to make informed decisions based on thorough research rather than hurried judgments. Ultimately, the calm surroundings support the demanding and sometimes tedious nature of financial analysis. Warren Buffett's investment approach is often described as uneventful or even boring, but this is precisely what makes it effective. Take his investment in American Express during the 1960s, when the company faced a major scandal. While others panicked, Buffett calmly assessed the long-term value and invested heavily, reaping substantial rewards as the company recovered. Similarly, his purchase of the Washington Post in the 1970s was made during a period of uncertainty. Yet, he held on to the stock for decades, allowing its value to compound quietly over time. These examples demonstrate that Buffett's style is not about chasing excitement, but about patiently waiting for solid businesses to grow. In this sense, the true meaning of yawn is steady, disciplined investing that delivers results without drama. It's important to understand that the concept of a yawn serves as a necessary starting point for profitable analysis, rather than its ultimate objective. The yawn represents an initial condition or trigger that enables deeper investigation and insight. By recognizing this prerequisite, analysts can focus their efforts on uncovering meaningful patterns and opportunities that follow. The true value lies in what comes after the yawn, as it opens the door to more substantive and rewarding analysis. Therefore, while the yawn is essential, it is not the final destination, but rather the gateway to greater understanding. Upon examining the evidence, it becomes clear that the myth of laziness is misleading. In reality, the true context centers on the importance of creating an environment where hard work can flourish. Factors such as access to resources, supportive structures, and opportunities play a significant role in enabling individuals to apply themselves. Rather than attributing outcomes solely to personal motivation, it's essential to recognize how external conditions shape the capacity for effort and achievement. This perspective shifts the focus from blaming individuals to understanding the broader context that influences productivity. By acknowledging these factors, we gain a more nuanced view of what it means to work hard and succeed. At the heart of investment decision-making lies a subtle but powerful enigma: the interpretation of signals from the market and peers. When investors mistake applause, such as enthusiastic market rallies or positive news, as a guarantee of future success, they may be lured into overconfidence or risky ventures. Conversely, interpreting yawns, like muted reactions or lack of excitement, as signs of failure can lead to hesitation or missed opportunities. These misread cues can paralyze investors, causing them to freeze in uncertainty, or mislead them into following trends that lack substance. Recognizing the difference between genuine indicators and mere noise is crucial for making sound financial choices. Ultimately, the ability to discern true value from fleeting sentiment separates successful investors from those who are swayed by the crowd. In investing, it's crucial to understand the distinction between process and outcome. The process refers to the systematic approach and decision-making framework an investor uses, while the outcome is the result of those decisions, often measured in terms of returns. A sound process increases the likelihood of favorable outcomes over time, but individual results can still vary due to unpredictable factors. This brings us to the concept of signal and noise. Signal represents meaningful information that reflects the true effectiveness of an investment strategy, whereas noise consists of random fluctuations and short-term events that can obscure judgment. Focusing on process and identifying signal helps investors avoid being misled by noise, enabling more rational and consistent decision-making. In the context of feedback, applause often symbolizes distracting noise. It can be loud and attention-grabbing, but doesn't necessarily indicate genuine quality or substance. On the other hand, yawns represent the absence of noise. This silence should not be mistaken for validation or value. It simply means there is no reaction. The lack of applause or criticism does not automatically imply that something is meaningful or worthwhile. Both applause and yawns are external signals, but neither provides a definitive measure of true merit. Understanding this distinction helps us focus on intrinsic value rather than relying solely on external responses. The real signal in investing lies in a disciplined and objective examination of a company's business fundamentals. This approach involves carefully assessing financial statements, management quality, competitive positioning, and long-term growth prospects. By focusing on these core elements, investors can estimate a company's intrinsic value, which reflects its true worth, independent of market fluctuations or hype. Such analysis requires diligence and a commitment to separating facts from speculation. Ultimately, this method helps investors make informed decisions based on substance rather than sentiment or short-term trends. It's easy to fall into the trap of paralysis, where fear of following the crowd leads to hesitation and missed opportunities. Avoiding popular investments simply because they're widely discussed can sometimes mean passing up on genuine potential. While caution is important, letting the fear of being seen as just another follower can cloud judgment. Many successful ventures have gained traction precisely because they offer real value. The key is to evaluate each opportunity on its merits, rather than dismissing it due to its popularity. Staying open-minded allows you to recognize and seize great opportunities, rather than letting them slip by out of concern for public perception. It's important to avoid the trap of justification when considering investments in failing businesses. Sometimes, the fact that a company is unloved and ignored can tempt investors to believe it's undervalued. However, neglect alone does not guarantee future success or hidden potential. Many businesses are overlooked for good reason, such as poor management, outdated products, or unsustainable financials. Buying into these companies solely because they are out of favor can lead to disappointing results. Wise investors look beyond sentiment and focus on fundamental strengths before making decisions. Ultimately, the real achievement lies not in the pursuit of applause or the avoidance of indifference, but in the dedication to rigorous, solitary analysis. It is through this quiet, persistent effort that genuine progress is made and deeper understanding is forged. While recognition may be fleeting, the insights gained from thoughtful work endure. The true great move is found in the commitment to challenge oneself, to question assumptions, and to seek clarity, even when no one is watching. In the end, it is this internal drive that shapes lasting success. The most important lesson for investors is that true safety and success begin with understanding your investments. This means taking the time to research each asset thoroughly, so you know exactly what you own and the reasons behind your choices. Relying on your own analysis helps you make informed decisions and avoid unnecessary risks. By building your portfolio on a foundation of knowledge, you can navigate market fluctuations with greater confidence. Ultimately, personal research is the cornerstone of responsible investing and long-term financial growth. Diligent analysis is the cornerstone of successful investing. Whether your research leads you to companies that are widely celebrated or those that seem dull and overlooked, the key is to remain focused on the facts. By tuning out market hype and distractions, you can make decisions based on substance rather than speculation. Remember, true value often lies beneath the surface, waiting to be discovered through careful study. Stay committed to your process and let your analysis guide you, regardless of where it leads. We'd love to hear from you. What are some of your own yawn-inducing investing habits that might be holding you back or keeping your portfolio stagnant? Share your experiences in the comments below. Additionally, if there's a particular investing quote or saying you'd like us to analyze in a future episode, let us know. Your input helps us create content that's relevant and insightful for everyone. Join the conversation and help shape our next discussion. Thank you for watching and taking the time to learn about safe investing practices. Remember, making informed decisions is key to protecting your financial future. Always research thoroughly, consult trusted sources, and avoid rushing into opportunities that seem too good to be true. By prioritizing safety and knowledge, you can build a stronger, more secure investment portfolio. Stay vigilant, invest wisely, and continue seeking reliable information to guide your journey.